on this computer. Okay, so good evening, everyone. So today we are going to work together on some problems for chapter 7. Okay, chapter 7 is about a bond. Okay, so so bond is an instrument, right? It's a financial instrument that is going to promise you. It's going to promise you a steady cash flow at periodical intervals until the maturity. At that time, you're gonna have a lump sum payment that is worth of the face value. Okay, so for a bond, they would have a face value. Okay, this face value is the final lump sum payment at the time of maturity. Okay, and the bond also have a coupon rate. Coupon rate. Okay, so the coupon rate is the rate in the contract, right? So the cash flow you received, okay, at the periodical intervals, those would be calculated by coupon rate times face value. Okay, so that will be the cash flow, the payment. Okay, that will be the payment. Well, this is apparently this is a promising sequence of cash flows, right? Annuity, right? Annuity with the equal cash payment of the interest, and also a final lump sum cash flow, right? So in order to exchange this future cash flow, you have to pay for it, right? You have to pay for it. So that's the price of the bond. Okay, so this is the formula. This is the equation. Okay, the price you paid for the bond, for purchasing the bond, if that divided by the face value, that should equal to coupon rate times this factor you are familiar. This is the factor that for the ordinary annuity, right? This is the formula for the ordinary annuity. Okay, so that will be the coupon payment, right? Annuity. That's annuity because the coupon payment are equal, right? For each payment, and it's spread out over multiple time intervals, right? And then this one is the lump sum payment, right? The final lump sum payment after time t. This is the discount factor, right? So this equation, this formula should not be that hard to understand. So what's the bond price? Okay, the bond price will be determined by the face value, the coupon rate, and the R, which is the discount rate of the market rate, right? And T is the time, right? The number of the intervals in the timeline. Okay. So if the coupon rate equals to the market interest rate, suppose the coupon rate equals the market interest rate, what is the price? Does anyone know? If coupon rate equals R, what is the price of the bond? Does anyone know? Do you know? When the coupon rate equals the market rate, okay, what is the bond price? Anyone? Okay. Yeah, market price. Okay, yeah. So at any time, it's going to be a market price, right? Because you are buying this bond in the market. So whatever the bond price you are going to pay, that will be the market price, right? How does this market price compare to face value if the coupon rate equals market rate? If the coupon rate equals to the market rate, okay? How does the price compare to face value? So this is very important. I want you to think about this. Anyone? I'm pretty sure some of you guys know the answer. Okay, so let's see. So if the coupon rate here equals to R, right? Then what happened in this formula is that you can see that this R is canceled out with this R, right? So then this one will become 1 minus 1 over 1 plus R to the power of t, and plus 1 over 1 plus R to the power of t, and this is going to equals to 1. Okay, so when coupon rate equals R, the market rate, the price divided by face value equals 1. This tells us the price equals to face value. Okay, so we are saying that the bond is issued at par. Okay, at par. This means that the price you are paying is equal to the face value. Okay, does this make sense? 1, 2, 3. Tell me, does this make sense? When the coupon rate equals market rate, what happened is the bond will be issued at the face value, and we say that the bond is issued at par. Okay, good. Okay. Okay, so this is important. It's important to know this. Okay. Now, what if the coupon rate is less than R? Okay, what if the coupon rate is less than R? Now, the bond price, how does bond price compare to the face value if the coupon rate is less than R? Do you think the price will be higher than the face value or lower than the face value? Okay, let's see. False. Okay, lower. Okay, lower. So you are saying if the coupon rate is less than R, the price should be lower than the face value. Why? Can you explain why? So why? Okay, why the price is lower when the coupon rate is less than R? When the price is lower, we are saying the bond is issued at the price is lower than the face value at discount or at premium. If the price issued is lower than the face value, we are saying the bond is issued at a discount or premium. Discount or premium? Discount. Thank you, Cheryl. At a discount, right? Because it's less than the face value. Now the question is, how can we rationalize this relationship? Okay, so why coupon rate is less than market rate? The bond has to issue at a discount. Can anyone tell me a story to rationalize this relationship. When the coupon rate is less than R, the market rate, the bond has to be lower, issued at a lower price than the face value. Anyone? So you could memorize this, but it doesn't help, right? If you just memorize it. The most important thing is that you understand, right? You can rationalize this process, okay? So let's make this clear. What is coupon rate? Coupon rate is the bond issuer promise to the investor, okay? So if the coupon rate is 5%, that means the bond issuer is promising the investor a 5% return, okay? So let's suppose that the market rate of return is 6%, okay? So if your product only promise you a 5%, that is less than elsewhere that promises 6%. Do you think I'm going to buy from you? Okay. So elsewhere they promise 6%. That's the market rate. And you only promise me 5%. Do you think I'm going to buy from you? Yes or no? No, that's right. So then what are you going to do if you want to sell your product? So people don't want to buy your product, right? Because it's too expensive compared to the market, right? Elsewhere. So if you want still to sell it, make it comparable to other things, other comparables, what are you going to do to sell your product? Come on, you know the result? You know the answer. Lower the price. Thank you, Cheryl. Yeah, thank you. Lower the price, right? So if you cannot sell it at the face value, because you are promising only 5%, people can rent it elsewhere 6%, then what is going to happen is you have to discount your product. So therefore, the price has to be lower than the face value. So that's why the bond is issued at discount. Okay? So now, what if the coupon rate is higher than the market rate? In this time, do you think the price will be higher or lower than the face value? These questions are too simple that you don't even bother to answer. It's like, too simple. Yeah. Higher. Thank you, Godfrey. Yeah. So the price is higher. So the same rationale, right? So when my coupon rate is 7%, right? I'm a bond issuer. I promise 7% to the investor. In the market, right? The rate is 6%. So everyone will come to me. They want to buy my product, right? So if everyone wants to buy from me, guess what? The price will go higher, right? So then the price will be higher than the face value. That's called a bond issued at a premium, okay? So it's important that you understand the logic, right? It's important that you understand logic at a premium. And of course, when the coupon rate equals market rate, we have already know that the bond is issued at par, equals to the face value, right? So this is really important because when you are solving a problem, okay, you sometimes, if the question wants you to solve the price of a bond, right, you can almost predict whether it's a discount or par or premium based on the relationship between the coupon rate and the market interest rate, right? So before you solve the problem, it will be just wise for you to make a judgment, right? Whether this bond is issued at a premium discount or at par. And then you do the calculation, and at least directionally, your result is correct, right? Because if you predict it's going to be a premium, but then you probably crunch the wrong numbers in your calculators, and you get a number less than face value, at least you know that something's wrong, right? Okay. So one way to picturize this relationship is you use the seesaw, right? Use the seesaw. So as the market interest rate going up, if the market interest rate go up, the price will go down, okay? So picture this as a seesaw. If your market interest rate go up, okay, the bond price will go down, okay? So you can see that if this R go up, this R go up, this R go up, so what happened is the price will go down, okay? So with this, let's do some problems together. This is our foundation. First of all, does this make sense? So give me a thumb up if you understand everything. 1, 2, 3. If you understand what I'm saying, this is really important. Give me a thumb up so we can keep going with the questions. Okay, very good. Okay, so now let's take a look. So when coupon rate equals R, the equation becomes price divided by face value equals 1. So then the price equals to face value. Let's take a look at this question. This question is from our textbook. There was one student requested for this question. So on page 257, there's question 20. I already typed the question on the slide. So the question goes like this. Air Butters Corp wants to issue new 20-year bonds for some much needed expansion projects. The company currently have 8% coupon bond on the market that sell for $930. Make semi-annual payments and mature in 20 years. What coupon rate should the company set on its new bonds if it wants them to sell at par? Okay. So in this case, we know that the face value, okay, the face value is 1,000, okay, but the market price is only 930, okay. So the bond is currently, the coupon rate is 8%, right? The coupon rate is 8%. Okay, so we know that, and the market rate, let's suppose, is R. Okay, so now the coupon rate, with the coupon rate at 8%, we know that the current price, the bond price, is $930, which is less than the face value 1,000. Okay, so it's issued at discount. So the reason why it's issued discount is because your coupon rate is not favorable compared to the market rate. So the market rate in our prediction should be more than 8%. Okay, so the market rate should be more than 8%. That's why this bond price is issued at a discount. So if you are with me on this, give me a thumb up, because I'm making a prediction. What is the market rate? It's more than 8%. Thank you. Good. Okay. So now, okay, the question is, if it's not 8%, what coupon rate do the company set on its new bond if it wants them to sell at par? Well, we just learned, right? The condition to sell a bond at par is that your coupon rate equals the market rate, right? So now this question is asking, what coupon rate should the company set on its new bonds if it wants them to sell at par? The question becomes for us to figure out what is the market interest rate, okay? So what is the market interest rate? There are different ways to do this, right? You could use the formula. This time let's use the financial calculator. Let's use the financial calculator. Now you're gonna tell me, okay, what is N? Tell me what is N? Because we are going to solve the interest rate, right? So you tell me what is N. I'm going to crunch into the financial calculator. N is 40. Thank you. So pay attention to the compounding situation. So semi-annual payments. So they are semi-annually compounded. So N equals 20 years, and each year times 2, right? So this is the number of the payments, okay, based on semi-annually for 20 years. So 40, thank you, very good. Now, what is my present value? What is the present value? PV. What is the present value of the bond? Okay, 930, very good. 930. And this is how much you are going to pay, right? So from the investor's perspective, this is the cost, right? So I'm going to put a negative here. This is the cash outflow from the investor's perspective. Okay? So the future value, so at the maturity, that's the future point. At the maturity, how many cash they are going to receive? Okay, I see 1,000. Very good. 1,000. So this is the cash flow from the bond issuer to the investor. Should I use positive or negative here? Is it positive 1,000 or negative 1,000? Positive. Thank you. Okay. Now I want to know the payment. Okay, payment, PMT. Payment is the coupon payment, right? So coupon payment equals the coupon rate divided by 2, right? Because the coupon rate by quote is the annual rate. And the coupon payment, the frequency is semi-annually. So the rate has to be divided by 2 because we are trying to figure out the rate for the semi-annual payments. So divided by 2 and times the face value, right? So the coupon rate is 8% divided by 2 and times the face value is 1,000. So my payment is $40. Very good. And so I want to figure out what is the semi-annual interest rate, IY. So this is the question mark. So now let's use our financial calculator. Let's crunch all these numbers into this. So I put 40 assigned to N, 930 negative assigned to present value, 1,000 assigned to future value, and the payment 40 assigned to payment. This payment is the payment from what? Because you have to think about this, right? Is this a positive or negative? So this payment is from the bond issuer to the investor, right? So this is the same direction as the future value, right? So the payment and the future value, they are the same cash flow direction from the issuer to the investor. So therefore, here is positive 1,000, here is positive 40, okay? So make sure you are not confused. So 40 goes to payment. Now I press compute. I want to know my IY. So the result I got here is 4.3735622205. So if you get the same result, please give me a sum up. 1, 2, 3. If you get the same result, please give me a sum up. Okay, good. So now, make sure you understand here is a semi-annual rate. So to make the coupon rate to be a APR, annual percentage rate, you have to multiply this number by 2, right? Whatever is number here, multiply by 2. So you should get, let's see, I'm 707. Okay, so you should get, let's say, 8.747%. Okay, something like that. So that would be your market interest rate. Okay, so you know the market interest rate. So the idea is when you issue new bonds, if you want to sell them at par, your new coupon rate has to equal to the current market interest rate, which is the 8.747%. Okay, so that's the solution. So if this makes sense, give me a sum up. 1, 2, 3. Okay, awesome. You guys are awesome. Okay. Now we are moving to the next question. Okay. Okay, so I want reinforce this idea of the bond issuance. When coupon rate is less than market rate, the bond is sold at a discount. When coupon rate is more than market rate, the bond is sold at a premium. And when coupon rate is equal to market rate, the bond is sold at par. Okay. Okay, so now let's take a look at the question 24. Okay, this is also from the textbook. I already have the questions on the slide. Suppose the following bond quotes for IOU Corporation appear in the financial stage of today's newspaper. Assume the bond has a face value of 1,000 and the current date is April 15th, 2016. What is the yield to maturity of the bond? What is the yield to maturity on a comparable bond of Canada issue? Okay, let's take a look at the first question. What is the yield to maturity? Well, the yield to maturity is also the market interest rate, right? So you know all these words sometimes used interchangeably, right? Okay, so let's take a look at what information we have. We know the coupon rate. Okay, so that's 7.2%. We know the maturity date, April 15th, 2026. Now we suppose the current date is April 15th, 2016. So from now to the maturity, we can easily figure it out that's 10 years, A equals 10. Okay, and the price is 108.96. What does this mean? It doesn't mean that the price is $108.96. Okay, this percentage is this number representing a percentage of the face value. Okay, so the face value is 1,000, and here the price is 108.96. So basically, the price, the last price was 108% and 96.96% times face value 1,000. So the price is actually, in terms of dollar amount, is 1,089.60. Okay, so make sure you are not confused when they quote the price 108.96. This is not means a dollar amount. This means, unless it's pretty clear with a dollar sign. If you only see a number, this representing the percentage of the face value. So therefore, I can easily know that the price was $108,960. Okay, 60 cents. So they want you to know the R, right? They want you to know the R. Okay. So with this information, we can figure out the R, right? We can figure out the R. So first tell me, and this is annual, right? Yeah, this is the annual payment. Okay. So first tell me, what is my N? Remember, this is the annual payment. 10 years, for a period of 10 years. What is my N? 10. Thank you very much. That's correct. And what is my PV, present value? What is the PV, present value? That's the current bond price, right? Yeah, okay, 108.9.60 cents, positive or negative? Positive or negative? So this is very important, right? Because it does matter with negative. Very good. Okay, future value. What is this? What is the future value? $1,000, good. And that's positive, right? That's from the bond issuer to the investor. What's the payment? So that's the coupon rate. In this case, the coupon payment is made annually. So you just use coupon rate times face value. So that equals 7.2% times 1,000. So that's 72, right? $72. Again, this is the cash flow from the bond issuer to the investor is positive. So I think that's it. So now let's figure out R, right? Can anyone quickly tell me what's R? Let's use financial calculator. Okay, let's see who got the answer. Anyone can tell me what's your answer? Okay, let's see. Okay, 4.44. Okay. So directionally, this bond is issued more than the face value. So this is a premium, right? So this is a premium. That means the coupon rate is higher than the market rate. So R has to be less than 7.2. So, and I have one answer here, it's 4.4. Directionally, that's correct. I mean, directional compared to coupon rate, right? So anyone else? Does anyone else get any other numbers that is different from 4.44? Okay, 5.983570,508. So this is what I got. Okay, this is what I got. So if you have a different number, try to rewrite again. See if probably you forgot the sign, the negative sign, or maybe press the wrong button. Okay, because this one, I'm pretty sure this is annual, right? Yeah, it is annual. Did you guys get this number or not? So Bernalyn, which number did you get? Okay, yeah. So if we, yeah, if yeah, I think that's the correct one. Okay, yeah, good. So now the first question that we figured out the yield to the maturity of the bond, which is close to 6%, right? And oh, good, Cheryl, you got 6% now. And 6% is less than 7.2. Therefore, the coupon rate the company promised the investor is higher than the market. So all the investors wants to buy from the bond issuer. So therefore, they charge a premium, right? So it's more than 100%. Yeah. Okay. So now, what is the yield? What is the yield on a comparable Bank of Government issue? Okay. What is the Bank of Government issue? So what happened is, this is a corporation, right? This is a company, right? IOU is a company, and this company issued this corporate bond that promise you a market return that is 6%, right? Yeah. So when you have return, it's always have risk, right? Remember, the risk goes along with the return. High return, high risk, right? So if you think about the investment of the cryptocurrency, right? Like Bitcoin, right? Those things have very high risk, right? Very high risk, but the return can be high too, right? So before it crashes, right? You think about it goes from like 20,000 up to 60,000, right? If you sell at the right time, you'll make a lot of money, right? So, but now, right, the price fluctuates so much. So high return, high risk, right? So in this case, the EST spread, this one measures the risk of the corporation. Okay, so this one is just a number. For every 100, it representing a 1%. Okay, so in this case, 468 will be converted into a 4.68%. Okay, so this the risk spread here is 4.68%. Okay, the Bank of Canada issue, this is a risk-free investment. Of course, if it's a risk-free, right, you are not taking the risk, your risk is lower. So now this one, this yield will be the Bank of Canada, right, will be the comparable issue, which is 5.98357, okay, this one. But remember, this one, the Bank of Canada, the government bond, right? If you trust the government of Canada is not going to bankrupt it, right? So there's no risk. It's risk-free to invest in the Bank of Canada. So it's very low risk. That means it's low return, right? So if you can invest to Bank of Canada, you can also invest into this corporate bond, right? The rate of return, the yield to maturity of the Bank of Canada will be much lower than the corporate 5.98. How much lower? That is measured by this spread. You can deduct 4.68. So I get 1.3%. Okay. So the bond, the government bond of Canada's return is actually yield to maturity is only 1.3%. Okay, if this makes sense, please give me a thumb up. 1, 2, 3. Do you have any questions? Anyone have any questions? No? Okay. So let me clear all this. Okay. Okay, good. So now let's keep going. Okay, question 3. An investment had a nominal return of 9.9% last year. If the real return on the investment was only 7.4%, what was the inflation rate for the year? Okay, what is the inflation rate for the year? So what happened is that suppose I'm a professor, right? My salary has been freezed for the last couple of years, right? So basically, the nominal return is 0, right? So every year, my pay is the same, right? So the percentage in terms of that is 0. But my real return is negative because of the inflation, right? The money is getting weaker and weaker because of the high inflation rate, right? If you make the same salary, your purchasing power is actually impaired, right? So your real return is actually negative, right? So what is the relationship between this? So this is called the Fisher effect, okay? The effect described the relationship between real rates, nominal rates, and the inflation. Okay, so I'm going to use R representing real rates and capitalize the R representing nominal rate and H to represent the inflation. Okay, so what we are saying is that even though it looks like you have a return 1 plus R, right? This is your return, but this does not represent your real return. Why? Because even though you receive more money, but you have to take into consideration of the inflation, okay? So maybe you make more money, dollar amount, right? So you calculate your nominal rates. It looks like, oh, 5%, right? Nominal rate. But your real rate is not 5%, it's lower because of the inflation, okay? So when this one is divided by 1 plus inflation, so that is your real rate, 1 plus R, okay? So the Fisher effect goes like this, okay? Goes like this. So your nominal return, 1 plus R, your nominal return, 1 plus your nominal return R equals 1 plus the real return multiplied by 1 plus inflation rate, okay? Does this make sense? Okay, 1, 2, 3. Give me a thumb up. Anyone else? Any questions on this? Okay, so let me give you one example. Okay, let me give you one example. Suppose your nominal return is 21%. Okay? Your nominal return is 21%. So that means in day one, you invest $100. How much you received a year later? 1 year later, how much will you receive? Your nominal return is 21%. So you invested $100. Your nominal return is 21%. How much you received after 1 year in cash? Come on, tell me. You know the answer. If you don't tell me, I'm not moving on. Thank you. Somebody said something. Okay, thank you, Cheryl. So that's 121, right? Because you earned a return of $21. So now you get $121, right? But don't forget, right? In this year, you also have inflation, right? So every year you're going to have inflation. It's just a matter of whether it's high or low, right? So let's suppose the inflation is 10% in the year. If inflation is 10%, in order to buy the same amount of goods, right? Let's say you use 100, there is a goods collection of goods worth $100 last year. This year, because of inflation, it's going to take you more money to buy the same goods, right? So let's say the inflation is 10%, okay? So a year after, how much money you have to pay for the goods that are worth $100 a year before? Okay, so can you tell me a dollar amount? So last year you paid $100 to buy a collection of goods. How much is going to cost you to buy the same amount of same type of goods this year? Just tell me. Okay, good job. 110, right? 110. So you can see that the purchasing power of the dollar is lower this year than last year, right? So now, after you taking care of the inflation, what's your real rate, right? What's your real rate? What are you gonna do? Well, I received 120, right? 121, but I cannot compare to 100, right? Because of inflation, I have to compare with 110. And this will be my real rate, right? You see, this is 1 plus big R, and this is 1 plus H. So 1 plus big R divided by 1 plus H equals 1 plus lower case r. You see how this formula coming from? Okay, so now after this explanation, does this make sense? Does this formula make sense? So 1, 2, 3. Okay, good. So with this, then it's much easier to solve this, right? So let's take a look. So 1 plus r equals 1 plus lowercase r plus times 1 plus h. So now, hopefully you still remember some of the algebra you learned. So there are 2 multiplications here with bracket. So now let's open this bracket. So I use 1 times 1, 1 times 1 equals 1. And I use 1 times r equals r. And then I plus r times 1. That's, sorry. Now I use h. H times 1, that's h. And then plus h times r, that's hr. Okay. So 1 plus r equals this. Okay. So you know R and H, right? This is the percentage with these decimals, right? So 1, 2, this R and H normally is a small number compared to 1. So two small numbers multiplication is even smaller. So sometimes this one is very small, okay? If it's very small to the point you can neglect it, right? So this is almost small to close to 0. And then you have a simplified equation. So 1 plus R equals 1 plus R plus H. So R equals lowercase r plus h, okay? So this is the approximation, okay? So if you really want to calculate the most accurately, you don't neglect this term. But if you want to have a rough approximation, you use r equals lower r plus h. Does this make sense? So 1, 2, 3. Okay, good. So now this question is much easier, right? So now plus 1 plus my real percentage return, my normal return, this is big R, 9.9, so that's 0.099. So make sure you have to write it as in the form of the decimals, right? So that equals real rate is, we know the real return. Real return is 7.4. So that's 0.074. And so that's equal times 1 plus h, right? So you just need to solve h. So that's pretty easy, right? Just solve h. Any questions on this problem? We are good. So let's move on to question 4. Okay, question 4. AB Builders Incorporated has 10-year bonds outstanding with a par value 2,000 and a quoted price 101. So this is the face value. Okay. And the price is at 101%. And the bond pay interest semi-annually. A yield to maturity 5%. What is the coupon rate? Okay, what is the coupon rate? Okay, so let's do this. So here, they pay interest semi-annually. Okay, so the coupon payment was made semi-annually. So what is my N? So this is a 10-year bond. So what's my N? 20, thank you. So 10 times 2, that's 20. Okay. What's my present value? The bond price. What is that? Yeah, negative 101. Okay, negative 101. Again, there's no dollar sign here, right? There's no dollar sign. So what does the 101 mean? I mentioned it just a couple minutes before. So what does this 101 mean? There's no dollar sign in front of it. So that's a percentage, very good. So negative 101 percentage times what? Times what? $2,000, thank you. Very good. So I have a negative 2020. So that's my present value, how much you pay. What is the future value? 2,000, yes. And that needs to be a positive. What is my yield to maturity for the semi-annually, right? It's compounding semi-annually. So that will be 5% divided by 2, right? So 2.5, very good. So I need to figure out what's the payment, okay? Because this payment will help us to figure out the coupon rate. So let's do it. Let's do it together. Sin 20 to n, 2020 negative to present value, 2000 to future value, 2.5 I and y, and I'm going to compute payment. So I got, this is what I got. Okay, very good. 51, 28, 29, 4, 2, 5, 7. So now the payment equals coupon rate. So this coupon rate we want to know is the annual, right? The API. So because it's paid semi-annually, that's divided by 2 and times future value, right? 2000. Okay. So now let's solve the coupon rate. So that equals, so this is 1000, so 51, 28, 29, 4, divided by 1000. So to make it this percentage, I just need to move the decimals one time to the left side. This is 5.18, 128%. Very good, Godfrey. Yeah. Very good. Navjit. Yeah. So that's my coupon rate. So let's check. Let's double check, right? This one is issued at 101%. Is this considered as a premium, discount, or par? If the percentage is 101. This is a premium, right? This is a premium. So why you are issuing premium, that means the coupon rate you are offering is attractive. So why is it attractive? Because it's more than the market interest rate, 5%. Okay. So that's why it's issued at a premium. So you make sure you double check, right? You double check. So if you understand this question, please give me sum up. 1, 2, 3. Okay. Any question? Any question? No? Okay. So that's the question 4. Okay. So let's see. Now question 5. Question 5. There is a 0 coupon bond that sells for 5,000, has a par value of 10,000. If the bond has 20 years to maturity, what is the yield to maturity? Assume semi-annual compounding. So this is a coupon, 0 coupon bond, right? What does this mean? When you are saying there is a 0 coupon bond, right? That means coupon rate is 0. So that means throughout the holding period, you are not receiving any payment. So all you got is the lump sum payments of the face value at the maturity. So in the midst of the holding period, you are not receiving any periodical payment, right? So there are two ways to do this. First, let's do this. Let's still use financial calculator. Tell me what's my N? Semi-annual compounding. What's my N?
40.
Thank you. So 20 times 2, 40. Okay. What is my present value? Yes, Godfrey. There's no interest payment. Present value? Anyone?
Negative 5,000.
5,000 and
Negative.
negative. Thank you. Future value?
10,000.
10,000. Thank you. And the payment? What's the payment? 0. Very good. So I'm trying to figure out the yield to maturity. So let's do this together. Use the financial calculator. So let me assign 40 to N, 5,000 negative to present value, 10,000 to future value, and 0 to payment, and then calculate interest. So what I got is 1.4. Yeah, good job, Brittany. You're right. Okay, and make sure you understand that this rate calculated is a semi-annual compounding. If you say the APR, you have to times 2, right? So you times 2, so 3.4959. So it's just almost 3.59, 3.4, sorry, 3.496%. Cheryl?
I just have a question. Is zero coupon bond also means zero interest bearing? Are they the same?
Say that again. Sorry.
Is it when you say zero coupon bond, is it also the same as zero interest bearing bond?
Yeah. Yes.
Okay.
Yeah. No
Okay.
interest. Yeah.
Okay. Thank you.
Yeah. So a different way, if you can use formula, right? So if you use formula, so then what is comes to, this is the generic formula for the bond price valuation, right? And the coupon rate is 0. So when you make this to be 0, right? 0 times anything equals 0. So this whole thing is gone to be 0, right? So now you are only solving actually a very simple equation. It's just the discount factor, right? So price is 5,000 and face value 10,000 equals 1 divided 1 plus R to the power of 40. And this equals 1/2, right? So you are just solving this, okay? Okay, so I think, so first of all, does this make sense? Give me sum up if this makes sense. 1, 2, 3. Okay, awesome, good. Do you have any questions? Okay, let's see. Okay, this is our last question. Okay, this is our last question. So question 6. The bond has a coupon rate of 4%. It makes semi-annual payment, and there are 3 months to the next coupon payment. The bond has a clean price of $960. The par value is 1,000. What is the invoice price? Okay. So the bond price is $960. Okay. And the par value is 1,000. What is the invoice? Because this payment is made semi-annually, right? And there are 3 months to the next coupon payment. So if you draw a timeline, so this payment is made every 6 months, right? 0, 6, 12, that's a year, right? And another 6, 24, right? This is the year 2, right? Something just keep going, right? 30. So we are saying that the price, let's say here, right? Let's say this is a time point. The price is $960. And there are 3 months, right? 3 months to receive the next payment, right? Okay, so the par value is 1,000. So how much they should pay? Okay, so the idea here is that you have to pay, because what happened is the clean price would representing that the payment on the 18th month. Sorry, I was drawing this picture incorrectly. Okay, so the next payment, when is the time for the next payment? The price is $960 here. Now there are 3 months to the payment. Okay, so if you want to buy now, so buy it here. You can buy it here. What happened is you have to pay half of the coupon payment. Okay, because the seller here, right, he is eligible for half of the payment, right? The seller here, at this time point, the seller is eligible to half of the next payment, which will be entitled to the buyer, right? So the price is $960 at that point, but they have to give the seller, that is 3 months, the credit of the 3 months payment. So what happened is the coupon payment is 4% times $1,000 face value. So for each coupon payment, there are how many money? $40. Okay, so that's the $40 for each coupon payment. Because the transaction time is in the middle of 2 coupon payment, so the seller is entitled to half because he's holding more time longer, right? So he's entitled for the half payment of the next payment. So that will be the $20, right? So you know that by the time of the next payment, the price is $960, and they have to pay that $20 of the $20 of that half of the coupon payment. So together, the invoice price should be $980. Okay, the price should be $980. So this is a question that is different to the normal situation, right? In a normal situation, you probably will sell the bond always at the payment time, right? Always at the payment time. So you'll be let's say I want to sell my bond at the 6 months, right? At the 6 months, so what that present value should be, right? And it's easier to deal with because the coupon payment is more likely has gone to the seller. So the buyer will start receiving the coupon payment from the next payment period of time, right? But in this situation, that transaction happened between two payments, right? So therefore, you know, in addition to the selling price, you have to also give credit to the seller of the time, right, they hold between the two payments to recognize this time value, the seller is holding that bond for 3 months. Therefore, he's entitled to half of the next payment. So you have to pay that. Half of the payment would be the $20. So therefore, when you send the invoice, you have to give the $20 credit. This is almost like when you think about a real estate agent, right? If you buy a house, the lawyer will make adjustment, right? So what happened is the seller probably has paid the property tax for the whole year, right? So if the seller has paid for the property tax for the whole year, and in the middle of the year, the seller sold the house to the buyer, right? So the buyer has to give half a year of the property tax credit to the seller, right? Because the buyer will be responsible for the second half of the year's property tax, which has already been paid by the seller. So therefore, the buyer has to pay the seller the half of the property tax. So this is the same idea, okay? This is the same idea. So the 18th month coupon payment will be received by the new buyer, but right, the seller has hold it for 6 months, right? So does this make sense? If this makes sense, give me a sum up. 1, 2, 3. Awesome. Do you have any questions? Do you have any questions? No? Okay. So the class is dismissed. That's what I'm gonna offer today. The class is dismissed. Stay around if you have any question. Okay. If you are leaving, have a good night. Okay. Take care.